Mr. Frostad, how are we, sir?
Hi, good, Matt. You?
Yeah, not bad, not bad. Had a bit good feedback from last week's session on the realities of what's happening in the market and what could be. So, what about you? Any
Yeah, we got
feedback?
a few calls on that one myself. Yeah.
Yeah, I like that. Good, and a good write-up. Are you going to release that white paper or what?
Yeah. We're probably going to set it up this week so that people can get their hands on it. Yeah.
Right. Okay. Cool. Okay. So, look, I think this week what we're going to talk about is maybe the way that, and I think something that'll help investors when they're sort of looking at companies and understanding companies in terms of the way that CEOs like yourself have to behave, have to think, have to solve for when it comes to sort of funding, their own activities. Right. So we've come off a very tough period. Exploration generally, even in good times, is hard. And maybe talk about how exploration actually gets financed. So I think that we're going to talk about a few topics today. One, we'll talk about obviously what those challenges are. Two, I think maybe look at flow through. We can look at a charity flow through as well specifically. How companies get valued. And how you get rewarded through discovery, and maybe different ways that, it seems to happen in the gold market a little bit. Does private money step in if it gets interesting? Do we need an exploration fund? And I think are there any things that we're sort of not cognizant of, not thinking about? So there's a lot to discuss basically. So if you're ready, armed and ready with all of your knowledge, I'm just going to throw a bunch of questions at you, just talking about, quite frankly, the joys of financial engineering for exploration companies. So can you sort of tell us a little bit about what headline view of what are the sort of challenges that you face and the things that you think about when it comes to finance engineering?
Exploration's a tough business, obviously, and because there's no certainty in it. So it's very difficult to find people who are willing to invest in it, and even when they do, it's quite obvious and apparent that there's you're dealing with a higher risk scenario with regards to how many of these things actually wind up turning into mines and the like. So there's a lot of the juniors in Canada here. There's a lot of juniors. I think most of the resource companies on the venture exchange are exploration companies, are well under $100 million in market cap, and being a public company, I think, creates a lot of not necessarily the healthiest of behavior. When our job is actually to take what is never a small amount of money and invest it in finding things in the ground in a prudent and efficient way. A lot of the structure around how we actually finance that, fund it, are watched. It sometimes fights that or creates inefficient, behaviors around doing what you do.
But if I think of I've kind of used this phrase financial engineering, and I guess by that I'm talking about the art of aligning capital, dilution, optionality, discovery timelines, etc. Where when I'm trying to listen to this, a lot of commentators in this market, they seem to kind of hone in on things like, spot price will solve all problems, right? Discoveries will be binary in outcome, value will be created, through one of those two things. But I think the reality is somewhat different. You need to construct the right environment to be successful. So how would you kind of when you look at financial engineering, what does that mean to you?
Well, I think number one, and this is, I don't think enough investors look at this in terms of how you value these things. But I mean, there has to be an obvious source of capital other than just flushing shares out into the market and hoping to hell that somewhere along the line you hit something. Because most of the things that you mentioned are uncontrollable. I can't time out to discovery. I can't give you a timeline to, where we're going to get and how we're going to get there. It's very choppy what we do. And in many cases there's longer timelines between programs and knowing what the results are and how those results even flow into things. So it's not a story that is conducive to the public markets necessarily, because it doesn't have that necessarily that news flow, and it becomes difficult. So you do have to fall back on things like the commodity story. I mean, that's what we fall back on to a large degree, and a lot of people will, because that is something that does move, our share price, and allows us to, then raise money, hopefully on the backs of something like that.
Well, like I want to stick with the kind of setup first of all, and we'll kind of get into the flow through
Sure.
and the different types of finance and the different ways of valuing and modeling companies' performance. And let's talk about, in your experience. I think we've talked about this once before. You talk about investing aligners with management and the types of incentives that need to be put in place. Because I think there's one phrase that annoys me profusely when management say, "Oh, we're aligned with shareholders." And sorry, I know it's nuanced, and we'll get into the weeds of it. And I'll tell you what, the thing that frustrates me is, and I said this to a few managers when they first started coming out with this phrase to me, was like, "No, you're not. You guys are picking up salaries, and you've got options, and goodness knows what else in place. So if it goes to shit, you're still picking up the salary, and you're wasting money, and you continue paying yourself a salary. So you're not exactly aligned. When it comes to shares, which company management team may have been given to a degree or definitely bought in the market, then you are directly aligned with shareholders, right? Assuming you haven't been given it at 2 cents or whatever, when the company's sitting around 30 cents. It's never perfectly aligned.
No,
So
but
how do you best do that?
You're also framing this, and that we've run into this so many times. You're framing this within the the
Confines?
the walls of what a normal business or a normal mining company or development company would be evaluated on. And that's the problem. So a lot of exploration companies are labeled, lifestyle companies, or yeah, you guys are just collecting a paycheck, because there hasn't been a discovery made yet. That doesn't mean everybody's sitting around the pool sucking a salary. There's work going on, and investors understand. I hope they understand that they're investing in exploration, which is a high risk venture that doesn't necessarily have the timelines we're talking about. So, should somebody, and we get this asked all the time, we'll do a financing and somebody will ask, well, how did you participate in that financing? Well, I raise money every single year. And this last one, no, because I don't necessarily, because in our situation where we have major companies funding our projects and validating them, I don't need to validate my projects by investing and buying up my own stock. Yep. Right. And certainly if I'm being compensated in an appropriate way, I'm not stashing away all kinds of cash to keep buying shares every year. So, I understand the frustration, but it's being framed as though we're just a normal business and we're or a developer or something with an asset. We're being paid to go out and find an asset and turn it, or something that isn't yet, into an asset, and yeah, that it's a speculative play.
So how should CEOs be remunerated then? Okay, it's a job, so you should be paid for doing a job, right? Marilyn and I have this conversation on numerous occasions, right? Look, I'm doing a job, so I need to be paid for doing that job, right? I'm actually quite good at what I do, so I think I should be paid accordingly. I think the thing that frustrates shareholders sometimes is when you see a CEO taking 2 bites of the cherry. It's right, I'm going to get paid, and I'm going to pay myself a lot, considering the size of the company and the value of the company, and I'm going to give myself cheap options. Should it be one or the other? Or is it reasonable to take, 2 bites of the cherry?
Well, I think it's reasonable to take both, but again, it can't be overwhelming, and we've seen it. I just went through an exercise of looking at all of our peers and looking at our non-peers. These, when you look at these companies that are under $100 million and they're explorers, what are they getting paid? Well, they should be getting paid, like the startup they are, right? People need to get paid to do their job, and if they're very good at it, and yes, the people that are working for these startups, if you will, are taking a risk, a career risk, like any entrepreneur would, and they should be compensated on the upside as well. But too many times we see all of those numbers they are excessive in a lot of cases. It becomes ridiculous. So I think it shouldn't, and too many times people don't seem to think that anybody in these exploration companies should be getting paid at all. Well, that's
I think the other thing that I think, and again, it's a Merlin conversation. Is it's like, once you're in these companies, as soon as you're as a manager, you've got your bills to pay. You've got stuff going on in your life, which is essential rather than nice to have, and you've got tax bills to pay as well. Certainly, the Aussies feel this and you need to sell stock. But as soon as you sell stock, you're going to get marked down for that. Right, that people don't like to see that. So,
sure.
Do you know that I don't know?
Yes, no, I agree. I agree with that for sure. But I mean, I worked for a number of years in within a venture fund with a lot of startups and in the technology space. And again, you got to pay people. These are not stupid. These are smart, talented people with a street value, for sure. So you have to pay people what to a degree what they're worth. And if you're going to give them all kinds of upside when things go right, then that should balance out the fact that they're probably not getting paid as much as they could if they were doing something in a more established frame of mind. But you're treating it like a startup. That's my point, right? It's not a
yeah. Okay, so well, you chose two sectors which are just highly unlikely to succeed. Okay, I don't know what the success rate is in
that's my life
in technology. Was it 1 in 20 maybe has a chance of surviving more than 3 years, and then thereafter it's going to put luck as to how long you'll carry on. I think mining's pretty much the same bag here. So yeah, you have smart people with tragically poor outcomes. But if it makes it big, I guess you've got to try and work out how smart or how lucky the general needs to be that you're going to back. Okay, so I think what we're saying then is it's kind of hard to judge the management team on success because it's an ongoing cash raising enterprise, which is and you need to try and make that first discovery is I guess the number one arbiter of success, right?
Well, and it may take longer, and usually takes longer than say a technology play, right? I mean, let's face it, technology has a shelf life, right?
Oh, yeah.
You've only got so much time
before
the market escapes you.
Yeah.
But in this case, we're dealing with a product that has no shelf life, and it may take a long time to find what you're looking for. And again, it's a different beast and should not be so quickly dismissed in terms of and this is what we see is that a lot of the analysts, a lot of the letter writers will dismiss this stuff because they've got a quick tagline, a quick question, and okay, you're out. And they don't necessarily understand it because they're not looking at it through the eyes of a venture fund, or through the eyes of the fact that this is a startup. This is not a business I'm investing in yet. But
here's the thing, right? With this sector, and like when I was back in banking days, we dealt with bigger transactions, 10 or 50 million plus type financings. Then you drop down to this kind of junior space, which kind of eyes were open. One amount of the percentage of the fees paid was extraordinary. I mean, to us, we're like, are these guys crazy? Then it was a case of how does one protect oneself from the inevitable dilution that raising capital inflicts on other shareholders, and what the hell's the management team going to do with it in terms of allocation of capital? Is it going to be a 1-for-1 return, a 3-for-1 return in terms of value? Do you trust this fundraiser is actually going to do anything for the company? So how do you kind of again weigh up that ongoing need for capital versus the risk to shareholder dilution, especially pre-discovery?
Mm-hmm. Well, you got to evaluate all of these. Unfortunately, you do have to evaluate all these things because you don't have a simple business to evaluate it based on. You don't have income and bottom line and cash flow and all that kind of stuff. So you have to look at management. Yeah, you got to look at what they're paying themselves. You have to look at how they're being compensated. Are they being properly incentivized, quite frankly, and to be there. And you have to, but you also unfortunately have to kind of look at at what they're, the property and the projects that they're manhandling. You've got to have an opinion on that as well somehow, and you have to look at their availability of capital. Do they have other ways of raising capital short of just diluting me into oblivion? And you've got to look at the commodity itself. Look at lithium when it went up and down and left and right, and things are getting wagged around based purely on the commodity. So you have to have an opinion on that as well. So it's a lot of factors, that can't be boiled down into a simple tagline.
But do you think, again, the other thing kind of sort of surprised me was I moved into the Canadian market from the London market, and these smaller projects, is the fact that the immediate, someone's got, right, I've got an idea of thing, I found an asset. The immediate thing you go to is, let's go and raise some public money. It's like, wow, why not mortgage your house and you and your buddies do the same thing, and then you kind of like plow your own money into this thing if you're so sure this is a great idea? Why are you using other people's money to go off and explore? You're not sure of what you're doing.
Initially, they should be, right?
Right, but they don't.
But they don't.
No,
Many
they definitely
do,
don't.
some don't. They should, but I mean, because it's so easy to do otherwise. Again, we're dealing with a framework and a structure and regulators and rules that have been put in place to encourage exploration and encourage these junior companies, but the guardrails haven't necessarily been put up to protect investors, or to limit how you get into this. I mean, because it's public money. I mean, when I went from technology into resources, it was like a brick in the face. It was just so different. I mean, in the technology side, you essentially had to either, you had to have a transaction. You either had to start generating revenue or sell the company. That's when you got your upside. All of a sudden, on the resource side, where you can do what you said, you can just become a public company and use other people's money. There's about 20 different ways to make money, that none of which has anything to do with finding something in the ground. And that's unfortunate, but that's kind of what's happened.
Yeah, I don't know. I still, maybe I'm just a bit old school on this one. I backed something about 2.5 years ago, and it was, someone came up with an idea about, like, if we roll up this land package, we can, for 3 different owners, and if we can maybe do some surface work, maybe we can, reinterpret historic data, do some drilling. We might have something here. Let's go public. I'm like, why do you do that? And I put in like 2.5 million US, was like 3.5 million Canadian into this thing. You know what? And if it had failed, no one's going to lose sleep for me or cry about it, because it's my money, right? And I'm a big boy pants on and go, well, I tried, and it didn't work, and that's life. But it did work, and the next thing was, do you want to write a check for 25 million? It's like, no, I don't. It still makes me nervous about exploration just generally. I understand the risk profile, but at that point, then we sort of put it into a public vehicle. That kind of, at that point, you meaningfully de-risk it. We'd found a bunch of copper, high grades. It was all kind of good stuff. I don't feel so bad about that, but kind of marching straight into it's probably got a 5% chance of working. Let's put other people's money into this. Unless, as you say, people walk in knowingly, go in and go, there's a significant chance of failure here. That's what I'm putting my money on. But the upside, if it goes right, is great. And as a blended risk approach to my portfolio, I'm comfortable with this. That's an okay conversation to have. But I do feel that retail do jump into this thing and thinking it's always going to work.
Well, you also understand the where a lot of this stuff starts out, because if I'm going to go public, if I'm going to create a new uranium company,
Yeah.
And, what will I do? Well, first of all, I got to go find myself a hunk of property. And unfortunately, that's kind of the way they're going at it. Rather than somebody saying, hey, I've got something great here, let's take it public, they're going to say, no, I'm going to go public. Let's go find something that I can throw into a vehicle. So, first of all, they're out there just shopping for something they can put into a vehicle. Now, when you take that project and you put it into either into a shell, or you take it public yourself, before there's a price tag put on this thing, you have to attract non-arm's length or arm's length, I'm sorry, financing, right? You have to find people that are actually willing to cut a check to this venture, to take it public. So there real checks have to be written out of the gate to get this thing going. Now, of course, there's many ways you can do that, and people are manufacturing this stuff in a way that they know that there's going to be an upside they can get out of tomorrow. Like there's too many side doors to this stuff to get it set up. So that doesn't mean that what most people do is they just abandon it. They just say I'm not investing in this stuff because there's too many loopholes. There's too much going on here. But if you're willing to take the time to look at it properly and understand who's involved, where they've been, how people are getting paid, where the money came from, what they intend to do, why they think this is worthy of why this is going to turn into something, you got to spend the time doing that, because we all know the Lassonde curve. I mean, you find something and that's where, you make 10 to 100 times your money. That's the big upside, but most don't. So, that's investment.
It is investment. Like I say, like for me, again, there's lots of learnings along the way, and I know what to avoid, who to avoid, and certainly the structures to avoid. Where some of the funniest things was people tried to attempt to get me involved in early days was the look, I've got a cash shell. It's not clean. It has some other crap in it. We'll just find it. If you've got an asset that you're aware of, we can sort of jam it in there. It's going to have a bit of an overhang for some shareholders. We'll clean it up as best we can. And even if we can't, it's, saves us a bit of time setting something up, because I don't know, copper is hard or lithium's hard or whatever the heck's hard at that moment in time. They're just trying to take advantage of a kind of momentum play. They're going to raise a ton of money to kind of get after something, and not even actually meaning it about the asset. Number one, it's like it'll get us going, get some money, we can pay ourselves, cover some costs, bit of travel and all the rest of it, and then we'll go and find the thing which we're actually going to get after, right? And I think that for me was a bit, I could never wrap my head around that. I could never get involved with that because it just felt disingenuous from the get-go, which shows a kind of thought process which I suspected would kind of carry on throughout the rest of their management of that project, that vehicle. So
but you're judging the people instead of the fact that they're utilizing a system that is made available to them, and there's no other way to get money.
Yeah,
really, the money you need, or it's the easiest way to get the money you need to go out and do some of this stuff. I was shocked when I got into this industry, how resilient it was, right? Because I mean, it's a weird industry. We don't sell anything. Nothing, right?
Hope.
We have no
Chris,
we
sell hope.
We sell hope. Well, in exploration you do, but even mining companies, Who are you selling to? You just manufacture stuff. You don't have customers necessarily. You don't know the meaning of customer service or marketing or sales, because you don't sell a product. Everything you manufacture just goes out into the ether, and you get paid for it at whatever price. You have no control over the price, and that's the problem. You get whipped around on the price. And so from that perspective, it creates it's a very interesting industry, because it's only the back end of what we normally think of as a business, and it's resilient as hell because we don't control the price, we don't control what's popular, we can't, and it gets whipped around from year to year, and people just slap a new bumper sticker on the old lithium car, and all of a sudden they're in the copper business.
But don't forget, there's a huge degree of this which is predicated on the greater fool theory. It's predicated on people not actually telling the truth because their stock, the value of their stock may go down. They may not be able to flip it to the next idiot along the chain. So that it's a kind of it's kind of keep your head down and don't say anything scenario. You know, like people who are like obviously invested in a pile of crap, refusing to admit this is a pile of crap. I'm super pissed. They have to go. They got to keep quiet because the more they realize this pile of shit is actually holding, you know, a lot of their wealth. Anything negative that they say will drive their wealth down. It's like self-inflicted torture, right?
Well, it's like the Roadrunner and Coyote. When the coyote runs off the cliff, he doesn't fall unless he looks down. You know,
yeah,
then he's
right?
done.
So that's the world we're operating in, and I think it's like extremely disingenuous. But because most of the sector is based on momentum and sentiment, and quite frankly, very mostly very far from fundamentals driven. It's fine. So when you say the word resilient, I'm like saying, what the fuck are you talking about? Pardon my French, but it's like it's not based on reality, right?
No, but if you're a geologist, this is your world. So when I say resilient, it's okay. Now I got to find another job. I got to earn a living somehow.
Well, if you're trained as a geologist, it's very hard to kind of segue off into something else, I guess. For in danger of me getting like a whiny little bitch here, should we maybe move into ask you some other questions in terms of let's talk about the market perception of clean capital structure and how you weigh that up against the realities of financing in a thinly traded sector like this.
The game is longevity of capital. How long have I got? It's a fuse before I just run out of fuel. And so when you talk about the capital structure, when these things come out of the gate, they're sitting with, in Canada, you're probably sitting with 30, 40 million shares. When it gets up to about 500 million shares, they've raised so much money and diluted everything to the point of thickness that they're running out of gas. Like the story seems to be running out of gas. But it's that, how do you keep financing this thing over whatever period of unknown time it takes to get to the other end of it? So, which is unfortunate because it means newer stories are more investable than the mature stories, which is actually backwards from where the opportunity may in fact be. So that's something backwards that happens because of the structure of this thing and the way we're financed. Yeah, I don't even know where to go from that.
No, I know what you mean. It's like people done a lot of work on, and I used to sort of joke about it at the beginning. It was like saying, companies used to drill, and the results were sort of roughly the same with sort of no end in sight. And it's like people are getting a bit bored of the drilling results now, and you need to move on to how do you build a business? Where's the growth through ounces in the ground, pounds in the ground is great, but to what end? When does this capital raising thing stop?
Well, it's like the third owner of a restaurant, right?
Yeah.
I mean, finally all of a sudden it's a winner because all the capital has been paid for by the previous losers. And so these things do, and how many times is the story, well, we're going back to something that was a mine. We're going back to something that was this, that, and the other thing. And they do find new stuff. And it is, it does turn into something. So, I mean, the question comes down to exploration is an essential part of the food chain here, right? I mean, without exploration, mines are just in liquidation mode. Because you got to keep filling the pipe at some point in time, and it's how do you fund it? How do you get who should be funding it? Where does that money come from? And what kind of a structure can you set up so that it's being spent in a manner that investors or whoever's money it is knows that it's being spent wisely? And I think that's the challenge right now is and this is the conversation we keep getting into, is that the money doesn't appear to be being spent wisely to the extent that I can even understand how the money's supposed to be spent. But it's people are picking up on things that just don't look right. There's a lot of money being spent on marketing or advertising, or there's a lot of money being spent on why is this little company got a CEO and a president and a COO, and they're all getting paid ridiculous amounts of money and sitting on, like, why is that happening? That doesn't look right to me. So it's that disconnect.
Right, but okay, and trying to get back even further back on track, and we've got to some of the things that we've seen over the past few years. These kind of hybrid models, and you're a partaker of that. In terms of partial spin out projects, royalties, JVs, etc. Has that? Will that just continue to be the way that exploration companies stay relevant, stay alive for a little bit longer?
Well, let's face it. The big mining companies or larger entities aren't going to start funding. They're not in the business of exploration. They're in the business of mining. So the exploration dial they can turn up and down at will, and they're only going to start getting involved in projects that are mature enough for them to get involved in, right? So what happens to all the early stage stuff? I mean, how do you find the things and invest in the things that the larger companies are even going to be interested in? And where does that money come from? I mean, in Canada, we know where it comes from. I mean, the government supports it. And a number of countries have got their own ways of supporting exploration in their particular countries, but even those programs tend to drive, not the right behavior in many cases, because again, we're driven. In the case of Canada, that mechanism the government uses is available to you as a public company. So all of a sudden now I've got to be a public company, and it's driving behavior that is not necessarily the most productive at that stage of exploration.
So how do you manage? How do you decide on and how do you kind of value the kind of trade-offs between saying, look, I think now's the time that this is your model. Now's the time for a strategic investor to come in, partly because I don't like the dilution of raising equity in the markets, and partly because maybe being too retail facing has its drawbacks, and maybe I'm just kind of a bit tired of doing these kind of we took these flow through type capital raises, these charity flow through capital raises that kind of retail seem to like. How do you work out what's the best model for you? I know what you've decided, but maybe put a broader hat on.
It is a balance, and it's because we're dealing in an industry that is typically starved. You also see panic behavior. People, making decisions on how they're going to finance stuff, probably in the not the best of ways. So the flow through stuff is tough because you what you're trying to do.
Maybe define it. So describe it for the younger investors listening in, or the overseas guys listening in. Can you describe what flow through and charity flow through is?
So what's happened in Canada in order to promote exploration in Canada is, if you're a public company, and it applies to private companies as well, but there's no liquidity in that situation. But I'm allowed to, because I'm an exploration company and I have no revenue, but I do incur a lot of expenses, and I have no revenue from a tax standpoint that I can apply those expenses against. What the government has allowed me to do is renounce those expenses, give those expenses to my shareholders. Therefore, I don't get them anymore, but they get them immediately. So what that means is, if you give me $100, if I sell you $100 worth of my shares, along with that, as an added bonus, you get a tax receipt. So you get a $100 deduction, personal deduction on your tax return. So you get that expense that I've just put in the ground. And so what that does is it means that it makes it easier for me to raise money, because we're taking some of the risk out of it, because I'm giving back. So if you're getting taxed, and I'm making up a tax number here, but if you're getting taxed at 50%, right? You just bought a share from me that's trading at $1, but I'm giving you $1 tax deduction, so you get 50 cents back. So you essentially just bought that share for 50 cents, where it's trading for $1. That's a good thing. So what happens is, now here's where things start to unravel, is a lot of those shares are sold right at year end when people are looking for tax deductions. They're being bought primarily for the tax deduction, not because they think you're necessarily a good investment. And they know that there's enough of a delta in there that they can get out and get their money back, because what they really want is the tax deduction. So that's one of the issues, is you've now sold your shares into very sloppy hands that are going to be looking for an out as soon as they can. And particularly if you're dealing with a flow-through fund, because what these funds will do, because the deductions are only available to individuals. So individuals will put their money into a fund who then invests in a whole bunch of different companies, and you can that flow-through can be renounced right down to it. So now you've got a fund that's sitting on all kinds of your shares, and they have no interest in staying a shareholder with you. They just wanted the tax deduction that they could scrape off the top. So those shares are coming back at you at some point as well.
It's a tough one, because I know, and I've had, may have had literally hundreds and hundreds of conversations, probably thousands now, conversations with CEOs over the years. Some guys swear by this as a fundraising mechanism. I think it's a case of, I'll take anything at this point. I'll take the big fat lass in the corner of the nightclub now, because that's the only thing left to me. Whereas other CEOs are cursing the day they chose to do charity flow through.
Depends on the scenario.
Cursing it. Yeah, well, I think I described one where you're just desperate, rather than focused on what's the right thing for the company. It's the best of a bad decision, isn't it?
Well, we've leaned on it heavily over the years, particularly when uranium was in the dumps. We could always, raise enough flow through that we could keep things going and keep things moving along and keep doing the work that we wanted to do, but knowing that was going to come back. So, you had to kind of pick and choose through some of these funds, make sure that you're dealing with we've got funds that we've dealt with over the years that aren't necessarily dumping our funds right out of the gate. But it gets you the money you need to do the exploration you want to do to get where you're going. Now, the problem is, though, is if you're going back year after year after year, and you're not necessarily coming up with a mine, and your stock price is sitting at the same price, then those shares keep coming back. They keep forcing your share price down. You keep diluting, and off you go. And so it starts to roll back on you after a while.
I think, to me, use my analogy of earlier, you're not here for the dancing. So it's.
But if you do find something, let's face it. If you can use that money and put it to good use, and actually increase, the value of your asset, your company, then it's been good for you.
But it's a short window. You get a short window to do that, right? And it's better be good news, and it better be news that. Because I think what I saw in the last couple of years was CEOs go say, like, we've got to come on. I've got this catalyst moment coming up. I've got a catalyst moment coming up. I'd wait sort of 3 months for their catalyst moment to come on. They come on the show and talk me through their catalyst moment. I'm going like, what the hell are you talking about? And even worse than that, the market's going, that's absolutely irrelevant. That's not what we're looking for. So catalyst moments, or definitions of catalyst moments, change over time. So if you've raised money to deliver a specific, allocation of capital, which you think is going to work for you, and then it doesn't, you're then going into using the same mechanism at a much lower price to do the same thing again. Definition of insanity. Also, I think it's quite a good thing from when I see that from me, I can work out which management teams are, put the fingers on the pulse, and which ones are just deluded, repeating the same mistakes.
Well, I'll give you a perfect example in our case, right? We raised about $6 million not that long ago at about 65 cents.
Yep.
4 months ago, when we were only 20 cents, we went out to raise some funds, and the market was tough. Like, all of our peers are having a heck of a time raising money. Like, it could not happen. And so we raised a smaller amount. We raised $1 million, which is fine. We just raised as much as we needed, period, I'll tell you, it's 23 cents. Within the next month or two, we made a discovery. Our stock went up to 50 cents. Then we got our assays back. It went up to 80 cents. Well, guess what happened 3 weeks ago is that $1 million all came free trading, because there's a 4-month hold on it. So now we've got a fund sitting on 23-cent shares that's trading at 80 cents. You think they're waiting for it to go to $1? No. So we see those shares start coming back onto the market, and we do whatever we can, and we've been doing a lot to soak up those shares so it doesn't. But it's this temporary pressure we get. We've seen here's a really bad scenario. We've seen a lot of people doing this. Was back when I said when everybody was having trouble raising money, and the bankers were pushing this, and it's annoying as hell. Charity, when you're doing your charity flow through, which is your flow through, but it's wrapped in another onion shell. The money that comes in to buy the shares is immediately donated to a charity, and then somebody on the back end buys it from the charity. So if I'm back to my dollar, I'm in the market for $1, I can actually get $1.60 for my shares. And once it goes through the grinder, it winds up in the hands of somebody that paid 90 cents for it. Okay. So now so that's fine. And if I know who that back end is and who bought it for 90 cents, hopefully it's strong enough hands that, we're fine for a while, and off we go. Well, there's an exemption now that the exchange here is allowed it's a life exemption, which is an acronym for something. And what it does allow you to do is avoid the 4-month hold. So I can sell shares up to $5 million worth under this life exemption, and there's no hold. Well, now, so then what? So that's fine. So now that's going to make it easier for me to sell my shares, right? Because now I can, whoever's trying to raise this money. Well, what if you're selling a unit? What if I've attached a warrant to that thing? So now I got a warrant at $1.20, and it's sitting in the hands of somebody who just paid 90 cents for it, who can sell it tomorrow. You don't think they're going to sell that share tomorrow and just sit on a free warrant? And that's what happens. And we saw so many companies who were having so much trouble raising money, and the bankers were going, well, here, let's do this. We're going to give them a unit. We're going to tack a warrant onto it. We're going to use the life exemption. That'll make it so much easier for us to sell these financings, which they do, and get paid the same rate as they ever would, or more so, actually. That's a whole other conversation. And then you sit back and watch. And day 2, after this thing closes, that share price just gets hammered down and down and down and down. Because who wouldn't do that? Who wouldn't cut a check for a free warrant? Yeah, it's ridiculous. And they'll tell you that, no, we're not selling this to loose hands. We're not selling these shares to people who are going to clip the warrant. But they do, and they are. And, all of a sudden you've got millions and millions of shares being sold the day after your financing, driving your price down to half of what it was. And those are the things that, your desperate CEOs are going to get on board with without thinking of. They're just thinking about what's going to happen today. I just need that money today.
Yep. And that's what I mean. It's kind of like, it feels like sort of desperate money.
For them to do things like, especially when they've got, their bankers jamming it down their throat, telling them, this is it. I can get you the money, but you can only do it this way.
Yep.
The only thing
bankers, I think it's well-established bankers don't give up flying.
No. Well, no, you're
what about this? They're looking for their fees. If the life depended on it, they'll probably come up with a different, better mechanism. I'm just conscious of time thing. I thought that we'd just be able to kind of flow through this in one session, but oh no, we've done it again, Chris. I think this is going to have to be maybe not next week's show. You're in New Orleans, aren't you?
I'm in New Orleans. You're in Chile, and we're
I'm in Chile, looking signing things.
We should talk about this because I think there is ways of doing this, but it's got to be done in a way that where the outcome isn't more bad behavior, right?
Well, look, let's do another session. I agree. Let's maybe finish off the kind of like flow through and current alternatives in the market, and I'm going to go not necessarily good alternatives, just alternatives, and I say different people need different solutions within a certain time frame, or they think they're going to crash and burn. I think the things that we've got left to talk about, I think it's what I highlighted at the beginning, which is basically that kind of risk reward that you get with news flow rather than sort of discovery probability, than the way that companies sort of manage that. I think private money in uranium would be a good one. Our family offices or sovereign funds, the next big capital source, or we're talking cryptocurrency coming in here. I think more broadly than that, will we see more funds, ETFs, maybe coming in here and kind of pooling multi-project funds together to kind of help this kind of patchwork quilt that we see. And then of course, if you or I can think of any thoughts about maybe, I guess, valuation blind spots, how do pre-resource explorers actually remain
I mean, at the end of the
priced.
day, investors have to make money. That's why they're there.
Yeah.
So unless you can structure this in a way that allows them, there to be a positive outcome, all right, and flatten the odds, then this stuff is not going to get funded.
Yeah.
It's just going to be a charity game.
I think it's a good conversation. And I know some of the long in the tooth and seasoned guys will be going, I knew this already. But I think there's sort of nuances about in terms of how management teams need to think and behave. So it's not like, I've made a decision because I couldn't be bothered thinking too hard about it. It's like, no, sometimes it's rock and a hard place situation. Sometimes it's a timing situation. Those are tough calls. Not everyone in this sector is an idiot. Quite a lot, but not everyone. So if you've got the right management team, you've got to trust them to make the right decision. If you don't think they are, ask them why they're not. Don't shout at them. It doesn't solve anything. Just ask them about the logic and the thought process. They'll explain it. So look, we've got to go because I've got to jump on to another call. Enjoy New Orleans, and then I think you're off the week after that as well. Are you? I'm off on a trip myself. I'm down in Mexico for a while, and we'll be in London. We'll be talking to all the good people. Yeah. Well, maybe I'll talk to you when you get back. We'll finish this conversation off then. I'll do Chile, let you know how it went. I'm then off to Australia for a week, and then in the Middle East for a few days, talking to some people there. So it's a good time to be in mining, that's for sure. And now that China and America have made up, it's all going to be fine, folks.
And Canada.
Fine.
And Canada. We're making up to, well, not with the U.S., but with China. We're starting.
Yeah. You're making it with? Oh, really?
Yeah.
Oh, that's good to hear.
What
have you done with China? They barely mentioned you.
Well, yeah, I know. No.
No, we've got the same problem. We've got the same problem in the UK. We've got a slightly deluded prime minister who thinks he's important on the world stage. So it's like irritating child. That always every classroom had that one irritating person, and if you didn't, that means it was you. So it's like
Look left,
you've got
right.
to get out there, get out of office, Keir Starmer is what I say. But right, gentlemen, folks, we'll see you soon. Ciao.